welcome everyone. Good morning or good afternoon, depending on where you're joining from. We're really delighted to have such a global participation for this webinar series. I'm excited to have you all here, including our wonderful panelists today. My name is Carolina Henriquez-Schmitz. I am Executive Director at the Grunin Center for Law and Social Entrepreneurship at NYU Law School. For those of you who aren't familiar with the Grunin Center, we are the first center of its kind housed at a law school with the goal of advancing a global movement that's creating new ways for law and lawyers to drive positive change in the world. Our mission is really to grow and expand and enhance the community of lawyers and legal institutions that are working in this field and advancing social entrepreneurship and impact investing. And we do this in a number of ways: through education, by educating obviously law students, but also practitioners about the legal issues that are coming up in the field, by developing resources and disseminating knowledge and legal research about key law and policy developments, and by, of course, collaborating with a range of different universities, research centers, and field building organizations, like the Bertha Centre. So we're really delighted to be in partnership with you all, developing this great webinar series. In addition to thanking the Bertha Centre for being such a wonderful partner, we want to take a moment to recognize the great contribution of the East Africa Private Equity and Venture Capital Association, Strategos Consulting, Adams and Adams, and of course, again, the Bertha Centre for hosting all of our in-person participants at your offices in Nairobi, Lagos, Cape Town, Joburg, and here in New York. We're really thrilled that this has had such a global reach. And by allowing for these hostings in person, we're not only making this a knowledge sharing opportunity, but really facilitating connections and building a network and a community of practice across the region. So thank you all very much. And before we kick it off, I wanted to turn it over briefly to Barry at the Bertha Centre. Barry, over to you. Can you hear us, Barry? We may have lost Barry, so I will keep going. Barry, feel free to interrupt me at any point if you are able to join or unmute your audio. We're going to just go over briefly the agenda for today. So as you might know, this is the second installment of a webinar series that is looking to help practitioners around the world build a legal practice in impact investing. And we've been focusing on three main themes for the webinar series. The first one that we touched on a few months ago was embedding impact into deal structures. Today we'll be focusing on blending and scaling capital. And our next webinar is scheduled for January 19th. We'll be looking at mainstreaming impact. We'll tell you a little bit more about the next webinar towards the end of this discussion. But for today, we'll be looking at two main panels. First, for the first hour, building capital stacks of investors with varied risk appetites. And for the second hour, we'll have when IFIs and DFIs come to the table. We'll be budgeting a few minutes, about 10 to 15, for Q&A after each panel discussion, but we're also budgeting an extra 15 to 30 minutes at the end of the webinar in case there are any questions that are outstanding. So if you want to stay on and want your question answered and we haven't been able to get to it, feel free to stick around. So without further ado, let me jump in to introduce our first panel. So the panel is building capital stacks of investors with varied risk appetites. This panel discussion is going to focus on the legal issues that arise in documenting and managing pooled capital structures across a range of investors that have different risk appetites. And joining us today, we have a great panel. If I may introduce them, our moderator is Carl Wallenstein. He's a partner at Morgan, Lewis & Bockius and a co-founder of the Impact Investing Legal Working Group. Among our panelists, we have Emmeline Liu, who's General Counsel at Calvert Impact Capital, John Grossman, who's Managing Director and General Counsel at Third Sector Capital Partners, Joshua Jenks, who's a partner at Bowman's, Lori Spangler, President and CEO of Include, and Lynn Rowland, General Counsel at Acumen Fund. So without further ado, thank you all for joining us today, and I turn it over to Carl.
Thank you, Caroline. I want to thank Caroline and the Grunin Center and Barry and the Bertha Center for doing this. I think I can speak for all of our panelists in saying we're very happy to join in this global initiative to share our knowledge around the world. It's truly global. Let me spend just a couple moments before I turn it over to our panelists decoding the title of this panel, because I'm not sure to what extent everybody knows what a capital stack is. That term comes out of kind of the project finance world, and it refers to basically the totality of capital invested in a project. And you imagine, you try to visualize it as a stack. You have at the very high end of this, the high end of the stack, things like equity and the higher risk things that tend to, because of the risk, ask for a higher return. And then going down to the stack, you have lower risk things like debt or hybrid debt, and at the very bottom, secured debt, which is lower risk and often a return that's lower than that. Now, translating that kind of capital stack concept to the impact investing world is kind of interesting. You might view at the top of that the high risk and the grants, concessionary financing, somewhere in the middle, hybrid debt or equity, and then debt. We don't see secured debt that often, but sometimes we do at the bottom. Now these capital stacks can be created over time. They're not all necessarily put in place at the beginning. They can be layered over time, and they can also exist in different levels of an investment. So you might have a capital stack at an enterprise, a social enterprise level, but you also very commonly, and I think you'll see that from the discussion with the panelists, see this at the level of a fund, using a private equity model where we aggregate capital, where you bring in different investors with different risk appetites into a fund, and it gets quite complicated in terms of managing waterfalls and distributions, and also trying to manage different agenda in the impact space. One thing that makes impact investing unique is it's not just the financial return, which in a normal project finance you're addressing, but it's also the impact measurement and mission that different investors bring in. They all have a different perspective on this. So that adds a level of complexity beyond managing the financial return, which is complicated enough. And you can have, the amount of complexity is you can be mixing debt and equity in an arrangement, and it can get quite complicated. So what I want to do is start off with our panelists is share some stories, because I think getting away from theory and talking about the practicalities of this is important. So I'd like to turn it over to our panelists in no particular order, and have them describe, a real-world example of a capital stack in an impact investment environment, the challenges kind of they faced, and some of the lessons they learned from that in terms of managing the complexity of that. So I'm just going to, Lynn, I see your lovely face, and I'm going to volunteer you to go first, and then we'll run through the panel.
Sure thing, Carl. So just for a little context, Acumen is a charity that raises philanthropic capital and does direct investing in social enterprise, but we also raise investment capital and manage those funds that are in turn returnable. So there's really two different types of scenarios that I'd like to explain this morning. In our direct investing in social enterprises, in the US, I would say we are typically the only impact-oriented investor in many of our deals. A lot of our deals have a tech angle, so there are more kind of tech VC type investors. And then these investees are also raising grant capital through various awards and things. And I would say in these scenarios, in the US scenarios, just an interesting lesson was how novel impact investing still seems to be, at least among the investee space that we're looking at. And we do not tend to take concessionary terms that are any different than our other investors in these US deals. In our non-US deals, we are often the only institutional investor outside of friends and family. And then often there could be other impact-oriented investors, but typically the investor body are impact investors beyond friends and family, and then as well as grant capital. And I think one interesting lesson from some deals we've done abroad is that there is still this capital gap, and the sort of intellectual pathing as to how an entity raises money, you know, starting with grants for R&D to seed to Series A, et cetera, tends to be a little more mixed up in the impact space because of this capital gap. These investees are just trying to get the capital however they can get it. And so maybe they'll take debt, even if that's maybe what intellectually you wouldn't say is the most rational thing to take, or they'll get grants for operating, to cover operating costs as opposed to something more discrete or R&D based. And I think initially in my practice with Acumen, I was a little judgmental of that and confused and wanting to like be instructive, but now I'm really coming to see that this gap is real, and investees are doing what they can, entrepreneurs are doing what they can to scrabble together the right basis of financing to test out their business models and grow their business. Then moving to the funds, as I mentioned, we have about $100 million in commitments across our various funds that we manage. And in our funds, we have a variety of investors. We have like foundations who are investing as PRIs as well as high net worth individuals. We have DFIs in those funds. And we have some commercially oriented institutions as well in those funds. And there are different needs that each of these types of investors have. And I think the subsequent panel is on DFIs, and they'll talk a little bit about what their mandates are. But working through those can be tricky with these relatively small fund sizes where we're relatively resource-light. So that's an interesting balance as to how to meet their legitimate mandates, but also make sure that you have the resources to be able to satisfy them. I would say that another lesson is in terms of enticing capital. We have a fund under development now where both Acumen as the charity and the UN-backed initiative are presenting essentially a first loss tranche, so junior equity in the fund. So there'll be senior equity, which will get return of capital first, and then we've created junior equity, which will then, after that, get its return of capital, and then they'll share equally in returns thereafter. But having to be a little bit creative that way, because a lot of impact investments with the poverty focus, which is Acumen's particularly focused, there is downward pressure on potential returns. And so we've tried to be creative in terms of figuring out ways to support bringing in third-party capital. And another thing that we've done, which it seems to have been appealing to our investors, is that we've created for profit share or carry that goes to the team and the sponsor. It's when the fund's successful, creating not only financial hurdles, so not only the preferred return to investors, but also creating impact hurdles so that we have to meet a certain impact target in order to get the profit share. And that seems to have been appealing to align incentives in addition to goals and reporting. I'll pause there.
Yeah, Lynn, thanks. I think you've given a great overview and a practical sense of this. Any of the other panelists, because I'm not sure we have time for everybody to share all their war stories. Anyone want to chime in with some additional comments, lessons learned that Lynn didn't touch on in her description? Anybody?
Sure, this is Emmeline.
Go ahead, Emmeline, you've got the floor.
Yeah, so I think that a couple of things as I was thinking about this panel that we've learned is that I think when we blend capital, we really need to blend risk as opposed to pricing. So I think that, there's a bit of confusion occasionally. It's not just getting a price that the borrower or the fund can live with, but it's really getting a risk profile that can unlock private capital. So you have to kind of be strategic about where you put the concessionary capital or the catalytic capital. As a lawyer, I think that the two things that I took away was that, the perfect is the enemy of the good. In these structures, they're novel, they're new. And so when we put them together, not everything is going to be perfect. So for example, we've closed a few funds in which there was an intercreditor agreement among the senior lenders, which makes folks very uncomfortable. But to get the deal done, we had to kind of get comfortable. And so I think that's one of the pieces of advice I would kind of give lawyers. And the other is not too many cooks in the kitchen. These deals have a lot of different players, and we have had instances in which, there was a $15 million deal with 5 different outside counsels. That's very, very challenging to manage, and really makes the deal almost unworkable. And I think finally, I think that you need a certain level of scale. I think that, for us, a fund size or a kind of a capital stack size of about $50 million is kind of a bare minimum. And you're looking, at least for us, to be able to prove the concept and then really to unlock private capital and kind of big private capital, which needs to be at scale. And so while deals of, $5 or $10 million commitments are great, in my experience, I think that the most impactful capital, like blended capital structures, are ones who start with a $50 million fund and then grow that to a $100 or a $500 million capital stack.
Let me throw another question out. Have any of you had a situation where, because of the complexity or the competing agendas of investors, you didn't invite somebody in? Or are we still in a world where we're so desperate for capital from any source, we're going to find some way to accommodate everybody in order to meet the funding commitments? Anyone want to take that on?
Carl, this is Laurie Spangler from Include. I'll take that on. I would say it's a bit of, my response is a bit of a hybrid. So I'm a lawyer by training, which is my credibility to be on this panel, but I actually operate now as the CEO of an impact investment bank. So I'm wearing the finance and the legal hats, I guess, in tandem. And I would say, I think we're still at the stage, Carl, where we can't exclude from consideration investors who have expressed a potential interest in that geography, that thematic, that subject area, because it is still really hard to get these transactions over the finish line. So I think ex ante, it's not as if we are, except in an M&A context, which I can come to in the context of your exit question, but for capital raising, we are not eliminating potential investors out of the gate. But what we are doing, especially in blended transaction scenarios, is we are pretty quickly and clearly steering people into the chair that we think is most appropriate for them in the capital stack. And if they're not willing to sit in that chair, showing them over and saying, thanks for playing, it's not your deal. Because the worst thing we can do is allow the investor, although we're an investment bank, we are always on the sell side, the origination side. So we are fighting for the terms and conditions for those who are going to deploy that capital for the impact objectives. And the worst thing that we can allow to happen, and we should learn from some of the microfinance experiences, is for the investor terms to dictate the business model or change the business model and thereby change, potentially dilute or modify the impact objectives that are at the core of the whole proposition.
Yeah, Laurie, and I think it's important that you add that. Now, you guys act as an advisor, and it's much needed in this space, but a lot of enterprises or funds don't have the advice from an experienced advisor and cobble these things together, and often make those mistakes. I mean, it is a problem that we've seen, and I've seen coming into things where clearly there wasn't anyone advising them on what not to do, and I don't know if you're seeing less of that and more people reaching out to advice. We're still finding deals that are where you're coming in a distressed situation to have to rescue them because no one was giving that advice on the front end.
We do have a number of those still, unfortunately, Carl. I would say we certainly are walking into some of those situations, but I would say more and more of the philanthropic funders in particular across their portfolios, some people like Shell Foundation, for example, are trying to arm their investees. I would talk about this in the context of sequential blending. So they may have started with grant capital as the initial intervention, but they see their investees now moving beyond grant capital into other types of capital. And they are on a portfolio basis trying to support those investees in acquiring the skills themselves, and if not directly, then the resources they need to negotiate better terms and conditions that, again, keep the centrality of the impact objective front and center. Lemelson Foundation has done a terrific job in that regard, looking at their India portfolio. So there's some helpful movement there, Carl, but we're still encountering situations where we're walking with asymmetry. It's a power asymmetry. At the end of the day, it's a power and information asymmetry.
Right. How about, let me throw out another situation where where interests appeared aligned at the beginning in the capital stack and everybody was in their right seat, but interests diverged and it became apparent that an investor either wanted to exit or needed to be helped to exit because it was creating stress on the structure. Have any of you had that, and how have you advised and navigated through that scenario?
Carl, it's John. Can you hear me?
Yeah, we can hear you fine,
sorry.
John.
No, I was just going to say, in the context, most of my, at least actual experience with blended capital is in the context of social impact bonds. Right. And in that context, we often find that there's a tension, particularly in some of the domestic projects where the social impact bonds have been tied to rigorous evaluation, to randomized control trials. In the UK and internationally, they've tended to be what evaluators would say is less rigorous. What I would say is more appropriate for the financial structure. And the reason is this: randomized control trials and rigorous evaluations almost always take longer than anybody expected them to do. They almost always require people to go in and change it and change assumptions, and there aren't enough referrals, so you have to extend for 2 years. And grant funders are perfectly comfortable with that and will often put in additional money. But if you have a 5-year senior loan that's attached to the project and they can't, because of the terms of their fund, say, well, we'll extend it for another 2 years, you get into a very tough situation where the structure of the financing starts driving the service delivery and the evaluation. And we've seen that in a number of occasions where we've talked about, can we buy out the senior lender, or does the senior lender just walk away, even though in an optimal circumstance, they would extend the time of the loan. Instead, they walk away and say, well, I'm going to go walk away with a loss, even though I know if I could stay in for another 3 years and do some kind of workout, I might get a return, but the fund structure doesn't allow for it. So we worry about that the tail starts wagging the dog in the social impact bond structure, particularly where you have these rigorous evaluations.
Right, good point. Anybody else want to share an experience on that topic?
I would just, this is Laurie, I would just double down on, I think that the time upfront, just there's no substitute for digging in as aggressively as possible in the expectation set going forward. But the time dimension that was just highlighted is really a challenge, because so many of the investors operating in the impact arena are operating through time-limited structures, not one, but a lot of them. And that becomes a real challenge, not only in the social impact bond scenario that was just utilized, but in other scenarios as well. And so really thinking about, in your capital stack, do you have some flex, some almost internal hedge on the temporal dimension of the investors around that table? Because oftentimes the best way to alleviate the tension that you highlighted, Carl, is that you have a takeout by one of the existing investors. Right. Someone new coming into the deal is just extremely difficult. So knowing who's around that table, the alignment between and among the folks, and the possibility that someone could step in and take over an exit scenario from an existing player, I think is certainly a hedge we try to build into most of our deals.
Right. Let me shift gears to a more philosophical question for you guys. We'll talk about the importance of concessionary capital grants and investments less focused on return and more on impact, and providing a catalytic effect and bringing in other capital that might not be there. Is there anything wrong with using concessionary capital for enabling others to make maybe a more market return in different places in the capital stack? Does anyone have any trouble with that, or is that actually a sign that it works, that everybody has different objectives, and the concessionary financer wants to have that effect and views that as part of its mission in bringing in other capital? Anybody want to respond to that?
Carl, I'll have a dab at it. Sorry, it's Josh here from Bowman's in South Africa. So, I mean, to speak to the ethics of it, I think, to my mind, what this does is it unlocks capital into an area that you wouldn't otherwise see it. And I mean, if I think of an example, you know, we have a big pool of funds that are available for investment into the education sector, and we've got funds that are set up to focus on private education for low income communities. Now, you wouldn't find there is not government subsidies, and there are not sufficient government subsidies to fund those sorts of investments, and so you need to unlock private funding. And to be honest, the only way to do that is to de-risk it through the government subsidies to make it more viable for private funds to flow. So I think you've got to look at it and say it's part of the same thing. You know, in order to get the impact, you've got to make it viable and de-risk it and make it more attractive for private investors as well.
Right. Anybody else?
Yeah, this is Laurie. The only thing I really agree with Josh's point, and I would just say that to me, the key is what your last statement, Josh, is that it's to achieve the impact you're seeking. And what I think is the danger sometimes is when you have commercial seeking investors joining a capital stack and seeking, quite honestly, that cross subsidy or that risk mitigant. They're very explicit about it. They're very clear about it, but not necessarily fully embracing and agreeing that the impact objectives are really the fundamental rationale for why this eclectic mix of people are sitting around the table. And that just can't be underemphasized as part of the deal, not just structuring of the deal, but the way the deal is managed throughout it. I think that's just critical.
Very, very, very good point. Just a message to our participants. Do submit questions using the online prompt. We're going to get to those in a few moments, and would like to have them queued up. Don't wait until the end, because poor Carolina will have to sift through all of them and try to select them. And so don't hesitate. Let me shift gears a little bit, and I know we're going to have an IFI and DIFI panel, the International Financial Institutions and Development Financial Institutions, but I want to get the perspective on this panel. And of course, I got to warn you guys, they're listening in, so we'll have to be diplomatic. You know, in terms of what effect it has on your deal, we all know they bring tremendous credibility, but they do come with a set of policies, procedures, and that can impact the timeline. So I wanted you to share your experiences with, you know, once you bring in, you start talking to IFIs and DIFIs, not just not-for-profits or impact investing funds, et cetera. We leave the private world and go to that public space. What has your experience been, and how have you managed that? Who would like to take that on but taking into account my caution that they're listening in now?
Carl, this is Emmeline.
Sure.
So we, I think in looking through all of our deals in Sub-Saharan Africa, in every deal there is an IFI or a DIFI. And we think that they are incredibly helpful, especially the ones with a more commercially minded mandate. Not only the seal of approval, but in terms of driving the deal forward and structuring, they can be incredibly helpful. And so, we think that they're essential, and we think that, I think they're really great. And I think in an emerging market, they are, they're almost a prerequisite for us to enter a deal.
Anybody else want to join in?
Yeah, perhaps I can speak to that as well, I suppose, as the South African lawyer on the panel. So I do a lot of work in setting up private equity funds, and there I can't agree more with Emmeline. I think if you don't have a DFI investor in an African-focused fund, you're almost doomed from the start. It lends credibility to the funding, and it signals to other investors that might come in at a subsequent close that you've got the right governance structures, that your ESG will also work and make sense. And really, it opens up your ability to raise further capital in a way that you wouldn't be able to do without the DFIs there. It obviously adds complexity, having competing agendas where you have purely commercial investors alongside DFIs. But I think in African funds, I think that that's just something that people have grown to accept, and it is part of doing business on the continent.
So I would just add a postscript, Carl, if I may. I would agree with Emmeline and Josh, very positive for all the reasons referenced. I would say the two insights, though, that we have gained is that oftentimes what we really think is critical is to make sure we're clear which IFI or DFI is the anchor. The comment was made earlier about too many chefs in the kitchen. We have definitely encountered challenges when we have 3 or 4 terrific DFIs, but there's just no clarity on who's really leading. And at the end of the day, for efficiency purposes and also harmonization of requirements, somebody's got to be the anchor. I think that's very important. We've also been in a situation where we've created competitive tension between the DFIs and IFIs so that ultimately we only want one. You're not always winning fans when you do that, but if you're transparent that that's the process, I think that's legit. I do think it's challenging when you have a deal only with DFIs, IFIs, especially if you're going to do follow-on rounds subsequently, and if there isn't that anchor. So I think the dynamic between and among the IFIs and DFIs is critically important, and lawyers have a huge role to play here because that harmonization of documentation is critical. Everybody wants their own reporting template, and if deals I was going to use as the example, the first deal, as you know the deal very well, Carl, that we did for BRAC in Africa alone, 13 investors. And we pushed that there would be one template. We pushed, and we hopefully professionally and not beyond the pale, but we pushed really hard because it was in the interest of the investee. And this is one of the challenges with DFIs and IFIs, and I think lawyers can be very constructive in helping to create that harmonization.
Have you been able to get like a common terms agreement or common policies? I mean, some of them have different statutes and mandates, and sometimes they're aligned and sometimes they're not. But I agree with you. It's absolutely necessary for effective management going forward.
We just did a club deal with two in Uganda about a month ago with 2 DFIs and 1 non-DFI. And we pushed for that, but it was still on a transactional basis, Carl. We haven't been able to succeed in that regard across something on a full portfolio basis, still on a deal basis, but it was a club transaction that we did create that. And ironically, it was the non-DFI player who set the standard.
You know, it's interesting. We have found coalescence, and maybe because it's a limited pool of investors on social impact bonds in the US, where there's sort of a sense now, okay, these are the documents, this is the reporting, this is the governance structure that's replicable place for place. The problem we have found is that to use Laurie's term, is on the investee side. So every time you go in and deal with a new government, a new state, a new county, they say, oh, no, we're not going to do it this way. And I think it's been a real impediment to scaling in the US because there's, 5,000 counties in 50 states, an endless number of cities, and each of them think they're special and know more than the rest, and they probably do, but it means that there's no economies of scale as we do more and more projects, that they become more efficient because you bring in this new player.
Right. I think the important point, I think everybody's spoken to the credibility and importance of having them in the deal. And also, in my experience, people like to complain about all the baggage of social environmental policies and the timelines. It's not as if putting these deals together with private sector, including NGOs, is a cakewalk, and it doesn't have its own challenges. So, as has been noted, they're often essential in an emerging market deal to have that credibility to bring in other investors. Let's talk about how the landscape has changed in the last few years. My experience is impact investors are getting a lot more sophisticated with their demands. They're being much more activist in terms of reporting and measurement, et cetera, and which I think puts a higher challenge on those of us who are deal architects and trying to make it all work together. I want to ask you to share your experiences and how this space, since all of you have been practicing in this space for many years, how you think this has changed and what the future holds in terms of increasing demands and requirements from investors in this space. Anyone want to take that on?
I can take that on, Carl. As some of you may know, Acumen's been experimenting with different data collection methodologies that are more shorter time frames and less expensive than randomized control trials, which are kind of like the best in practice for impact measurement. The problem with some reporting can be that it's very top down, so it's meant to serve the needs of the person receiving the reporting. And we've been trying to be creative about how to deal with the needs of the consumer, who presumably we are doing these deals for, as well as the enterprise that is trying to figure out how to create a good or a service that is optimally utilized by its consumers. So we've actually experimented with something we're calling lean data technology, which is due to the penetration of mobile phones in the regions where we work, sending surveys, like standard survey sets onto consumers to collect information from them directly, where we can get a lot of really robust information that can measure poverty focus, which is something that we care about, as well as meaningfulness as to the intervention in this person's life. And then feed that information back to portfolio companies so they can actually use that to tailor the good or service in a different way to help consumers. And we found that it's, again, because of the short time frame, relatively low expense, and utility of the information, that portfolio companies are actually eager to use this information and eager to support us in engaging in these data collection projects. So again, it's us collecting the data as opposed to the enterprise itself. But that's been something we've been experimenting with, I think, to good results.
Carl, I would add something from an observation of a trend kind of in a different category of maybe newer entrant to the impact investing conversation. And these are some of the institutional investors who are beginning to explore, if not create, some allocations. And there, your point about sophistication and complexity and rigor, absolutely well taken. But one thing we've learned on these blended structures is that there's an institutional rigidity and challenge to the underwriting of these deals with the bigger institutional players. And we've learned this the hard way. I gave the example this morning in another conversation where we structured a Luxembourg CCAF SIF, so an open-ended permanent investment vehicle. It was a regulated structure. We thought it was of a size and scale, and with the regulation would be attractive to institutional investors. They found the thesis very compelling, but they had challenge with the product, which was a private equity product with current yield. Now, most people would say, wow, private equity and current yield, I like that. But what we found is with the big institutional investors, they didn't know where to put it. They couldn't put it in the fixed income category because it was a private equity product. The private equity guys didn't know how to underwrite it because it had current yield associated with it. And it sounds almost a silly challenge to have, but we have definitely learned our lesson that if you're going to blend and come up with some alternative capital approaches, and you intend to attract big institutional capital, be very careful. And innovation, there are boundaries to innovation, and standard familiar instruments with maybe more some kind of tweaked, enhanced terms and conditions of those instruments is a better path than actually at the core of the structure being overly innovative, even when you're clear as to why you're doing it. So I would share that as an observation.
Right. I think last question from me, and then we're going to open this up. I'd like to hear from you your elevator speech, meaning a short speech to an investee on what are the key points in building and managing a capital stack. You know, if you have to cover it in 30 seconds, what is your key message to them? And anybody, Lori, you probably have some thoughts on that, but anybody else?
So blending sounds great, but let's be really clear. Why are we blending? To what end is this capital stack in service of? The money is in service of something else. So let's be really clear around the business table. What are we doing on a day-to-day basis? What are the impact objectives of what we're doing? What's the cost of capital that you need to be able to deliver on that impact? And then reverse engineer into what that capital stack needs to look like. Form does not drive substance, substance drives form.
Well said. Anybody have anything to add to that?
I would just add that I think it's critical as you go into these arrangements to understand that we are still innovating, and that we could spend a lot of time, hundreds, if not more hours, negotiating the corner case. And almost inevitably, the case that comes up is not going to be the corner case that we negotiated. So there has to be a level of trust. These are business transactions, but I think they're almost better thought of as partnerships, not from a legal sense, but from an intellectual and an emotional sense, so that we know that down the line, when a problem comes up, having identified the goals of this endeavor, as Lori spoke about well, we're going to negotiate and deal with it then, as opposed to spending hundreds of hours and thousands of dollars trying to anticipate what is fundamentally unanticipatable at the front end.
Can I just do one postscript? I so agree with that. I so agree with that, John. And I would just say that the currency of trust is the clarity around the impact objective. And because without that, you don't really get there on the maneuverability and the adaptations that you're exactly right are inevitable.
Okay. Carolina, anybody have anything to add before I turn this over to Carolina to ask some questions? Anyone else?
Yeah, Carl, can you hear me? It's Lynn.
Can hear you fine.
Just to build on what was just said, on the fund level, these capital stacks, like again, as has been said, but just to emphasize, make sure you have the right partners and that you do have the glue of values and impact alignment, or it could be very challenging as you actually go into execution mode. And on the enterprise level, I would say think beyond the immediate term. Don't think about this financing, but think what you may need in the midterm and how the capital you take today will impact your raises in the future. That would be the other steer.
Right. I mean, I think a key point, without shared values, shared sense of impact, no matter how good your lawyers are, they're not going to fix it. You're going to run into problems. That there has to be that common understanding. Carolina, let me turn this over to you to share any questions from our participants that we can have our panelists address.
Absolutely. Thank you all again. That was a great panel discussion, and we have a few questions to share. So I'll just start reading each one. I'll let you guys decide how you address it, and then we'll go to the next one. So the first question we have from the audience is, touching on impact investments in West Africa, particularly Nigeria, can you say that the local investment regulatory regime engenders impact/social investment? If the answer is in the negative, what have been the challenges and how do you suggest that these challenges can be surmounted from a legal and practical perspective?
Anybody have any relevant experience to share? I don't with Nigeria, so I can't comment on that.
Yeah, I can. Well, maybe Josh, do you want to take that first? I have an experience, but I didn't want to.
Sure. So I don't have proper experience in impact investing in Nigeria. We've done other deals, real estate deals, for example, in Nigeria. And I think that the general experience that we have when we are looking at projects in Nigeria is a concern from investors that you may not be able to get your money out of the country. And I think that informs any investment decision into Nigeria, whether you're looking in the investment space, in the impact space or otherwise. So, without knowing about any local regulatory requirements, I think that is just a fundamental concern that we're seeing. The one useful thing, obviously, is that a number of the funds have a sub-Saharan mandate, and there is only a limited number of places to invest where there are real growth opportunities. So there is a strong focus on trying to work through these issues, and there is a lot of effort going into that. But I think that is a fundamental challenge that we face when we're looking at investing into Nigeria.
Yeah, I would agree with that, Josh, and it's a similar experience for us. I think, sadly, I think the answer to the question as it was posed, I think there are some real challenges in the signals that are being sent. I think there's a country risks challenge where the legal and regulatory inputs to that are contributory, and then there's that's different or distinct from the individual enterprise or credit risk. And I would say on the positive, I think there have been steps that, for example, in the banking sector, the central bank regulator has endeavored to take some positive steps, at least under the former presidency of the central bank governor, in the sense on sustainability and saying that sustainability factors in bank lending are going to be an obligation and expectation of the banking sector. That was a really exciting period. And I think it was galvanizing a new category of investors to even look at the Nigerian financial institution market, and especially in thinking about SME finance. It hasn't been sustained, sadly, but I do think there are opportunities where people in a lead regulatory chair can really set the tone for impact investor appetite and willingness to get involved. But it's no substitute for the fundamental point that Josh made about the legal and repatriation of proceeds.
Okay, Carolina, next question.
Next question. When is it useful to explore a blended finance instrument? For instance, if a government has significant capital available with lower required return, then when is it worthwhile accessing private instruments with higher required return?
Well, I think, I mean, we've spoken to that in part, that the catalytic nature of government concessionary financing is often necessary to bring in some of the private capital as a risk mitigant. So it's often a driver. You can't go out to the private market without that government, catalytic capital, which is often on concessionary terms. I don't know if anyone else has any, other comments in response to that question.
I think there's a story or that one of the reasons to have return-seeking investors in a capital stack is they bring more discipline, and they're more focused on whatever the outcomes are, whatever the return mechanism is. And I was honestly skeptical of that. I actually think it's true. And I think there is value to having people whose ideal is workouts and we're going to figure out how to work through the problem, as opposed to sort of traditional grantors who say, who are comfortable with a negative 100% return, and either their option at the end of a project is binary, is give another grant or close it out and walk away. So having people that have a different focus, I think actually often can lead to better projects. And that's a substantive reason to have that return-seeking capital.
Right. Good point, John. And I think, there's only so much governments can do in terms of funding, and they get exhausted at some point. And bringing in a new capital base from the private sector, in addition to the discipline that you mentioned, it's also, it introduces the enterprise to new sources of capital. If all goes well, they might be able to tap into that into the future without even the government assistance in an ideal scenario. But point well made, Jonathan. Anyone else want to add to that?
Yeah, one more point to build on that would be that there could be strategic reasons, like there could be private investors who have experience in that particular sector, or the particular operational needs that the company has right now that could be particularly value additive.
Okay, Carolina, any other questions?
We have one more question. Does imposing a minimum scale of projects result in many projects that don't meet the threshold being taken on?
And by scale, we mean minimum dollar amount or scalability. I guess it probably means minimum size. I think,
I have a clarification on that, but if whoever submitted the question wants to type in the clarification, please feel free to do so and I'll share it.
I think, and Emily made this comment, the problem of complexity of blended capital stacks, it takes a lot of work for very small deals. It may not be worth it. It may be better to look at a simplified structure that's not a complicated capital stack. So there's a certain size that's probably necessary for the complexity. That's been my experience. Anyone else want to comment on that?
Yeah, since this was kind of my point, I think that it unfortunately does exclude certain projects, or at least at certain projects at certain stages. It costs, in terms of transaction costs, just as much to paper a $10 million deal as a $100 million deal. And without that type of scale, it just doesn't, it's not economically feasible. And additionally, kind of thinking about both in terms of scale and in terms of scalability, I think that where catalytic capital and where kind of our efforts should be directed is something that could be scalable, right? That could unlock very large financial institution tickets to really kind of meet the SDGs. I think that that's what we need to be doing and focusing on. So while the little projects can be really interesting and wonderful and great ideas, I think they're not as kind of friendly to blended finance structures. And then I guess to add to an earlier question, I think one interesting thing that if folks were interested is in terms of when to think about blended finance. If you go to the Calvert website, we've actually created a financial supply chain framework, which talks about the importance of catalytic capital at different stages. Because I think that catalytic capital, depending on the stage of where your fund or your borrower is, comes from different sources and can do different things.
Caroline, any other questions in the queue? How are we doing on time? Are we on track?
Yeah, we're perfectly on time. Those are all the questions we have from the audience. But again, if you have any other questions now or over the course of the continued discussion, just feel free to submit them in the Q&A and we'll try to make sure to get to them at the end of the webinar.
All right, panelists, just how much time do we have left, Caroline? A few minutes?
Yes.
Okay. To my panelists, any questions I didn't ask that you would like to have been asked that you want to share in making any concluding remarks on this topic? And any thoughts here? We could go on, but I'm reluctant to start a lengthy discussion with just a few minutes remaining on this. Any other words of wisdom to share on this topic that we didn't?
I mean, I suppose I've just got a question, I suppose, to ask to the other panelists. I mean, looking outwards from an African perspective, I mean, is there anything that we're doing wrong that you think we could do a lot better to attract more investment in this space?
I can mention something. There is a regulatory framework that requires, it's a competition, I'm going to get the name of the act wrong, but a competition act that requires registration of private investments, and strict compliance with that is really, I think, inhibiting of bringing capital into the country. I mean, it's expensive, time, it's like 3 months to do the filings, it's tens of thousands of dollars. It makes, it's incredibly expensive, especially for smaller style deals. Any comments on that? Do you know what the act I'm talking about?
So I'm definitely not a competition lawyer, but I think you're talking about the COMESA regulations, if I'm not mistaken. All I can say is that there has been significant effort. My colleagues at Bowman's are very involved with COMESA and with lobbying to try and certainly get more understanding, a greater understanding, and more certainty on how these are meant to operate. And I think there has been quite a lot of movement over the last year or so. So perhaps we can discuss that as well offline and see if there's anything we can do to help.
Joshua, the issues that I've had in the deals I've done in Africa, it's common to many emerging markets. It's transparency, reasonableness of regulation, and it's also predictability. The problem is, regime change or results in lack of predictability or lack of certainty, and not just in the regulatory environment, but also in the fiscal and the tax environment. Some of your comments on the issues in Nigeria are problematic regardless of whether it's the impact or non-impact investments.
Yeah.
If there are issues regarding repatriation of capital, and you care about that, and it's not just a grant, you're not going to be going in. And I think those issues, it's not just Africa, but it is Africa. It's Latin America, Southeast Asia, whatever. Those are the classic issues of concern to any foreign investor.
The 10-second mention I would also add is we've got to unlock domestic capital markets in Africa. If we're really going to move the dial and really breathe life into the investment landscape, I think figuring out ways to chip away at some of the existing barriers for the domestic capital markets across Africa is critically important.
I think, Carolina, we're at the end of our time.
That is correct. Let me take a moment to thank you all for such a great discussion. I'm sure that there are a lot of insights and practical takeaways that the audience has been will greatly appreciate. Just here in this room, I've seen people typing away furiously the entire hour. So thank you all. Before we move on to the next panel, just to remind everyone, we have a chat function in the Q&A. If you have any questions, technical issues, feel free to use the chat function and send us any questions you have over the course of this discussion through the Q&A, and we'll get to them at the end. So to introduce briefly our next panel, when IFIs and DFIs come to the table. This actually, the part of the conversation you were having on IFIs and DFIs during the last panel is a perfect introduction and segue into this conversation. The panel is going to consider the benefits and challenges of dealing with institutions whose funding comes from governments and taxpayers. So the speakers will discuss the aspects particular to international financial institutions, or IFIs, and development financial institutions, or DFIs, such as their mandates, policy needs, risk tolerances, investment horizons, and how these institutions work to crowd in rather than crowd out private funds. Panelists will also explore the extent to which institutions are utilized in blended finance structures and the benefits and risks arising from those structures. Joining us today for this great panel discussion are our moderator, Deborah Burand, sitting to my right. She is Associate Professor of Clinical Law at NYU School of Law and Faculty Co-Director of the Grunin Center. Deborah is also the co-founder of the Impact Investing Legal Working Group. The panelists for today's session are Amy Bailey, Associate General Counsel for Investment Funds at Overseas Private Investment Corporation, that may be ceasing to exist. Gail Giraud, who's Chief Innovation Counsel and Assistant General Counsel for the Global Development Lab and the Bureau for Economic Growth, Education, and Environment at the U.S. Agency for International Development. Christopher Gardner, Legal Director at DLA Piper and former Senior Counsel for Private Equity Funds and Equity Investments at FMO. And last but not least, George Rogers, Lead Counsel at the Inter-American Investment Corporation. Thank you all again for joining us, and I'll turn it over to Deb.
Thank you. So I'm just delighted to be able to moderate this panel for a couple of reasons. One of which is it's always great to have panelists that are as smart and experienced as the folks you're about to hear from. I always learn from these conversations. But another couple of reasons why I think this is a terrific opportunity for us. This is as those who started with us at 9 this morning heard about the Grunin Center. We have a mission of both education of lawyers, both law students and those that are practicing, as well as disseminating knowledge about legal issues and policy developments in this field, and finally collaborating with others. And actually all three of those things are here present in this webinar. So it truly is advancing the mission of the Grunin Center. And finally, I've had the wonderful opportunity over my career to work both for a bilateral development finance institution and a multilateral development bank in a legal capacity in both places. And so I can tell you these are quite unique organizations, and in thinking about how to work with them, there's quite a lot to be learned. I think what I'd like to start our conversation about, because we sort of glossed over this a little bit in the last conversation, but I'd like to maybe dive a little deeper into what we really mean when we say the words blended finance. And I raised this because I was asked to moderate a conversation a couple months ago about how to stimulate more blended financing, only to find out that no one at the table had the same understanding of those words. And so if you're going to talk about how to get something moving, we need to make sure we all are talking about the same. I think we can hear you, George, on your side. Can you hear us?
Just so you know, we're having some technical difficulties, so our video will pop in and out, but we will, our audio should remain stable.
Perfect. Okay, thank you very much.
But also, are you able to mute and unmute us?
Yes.
Okay, great.
Can we mute them? Yeah.
We'll let you do that then.
Okay.
If we're talking and yeah, okay. I just saw
Okay,
her.
thank you. No, I'll keep going. That's fine. So what I was saying is, so blended finance, it's a new buzzword in impact investing. Certainly blended financing has been going on for quite a while. So what does it mean in the impact investing context, and what is it? You know, not unlike a lot of terms in the impact investing world, there's not a common agreed definition. And so I'll give you a couple of definitions that people use when they talk about blended finance. The Global Impact Investment Network, the GIN, defines blended finance as this: a strategy that combines capital with different levels of risk in order to catalyze risk-adjusted, market rate-seeking capital into impact investments. The OECD has a slightly different definition. They do two things. They add specific impact goals, that is the sustainable development goals, and they also put geographic boundaries around that definition, saying that blended finance is the quote-unquote strategic use of development finance for the mobilization of additional finance towards the SDGs in developing countries. So you're already seeing that there are different points of view about what this can be. So my first question to my panelists, so we are going to take the mute off of our friends that are sitting in DC, and Chris, for you as well. How would you define blended finance? Is there anything in these definitions that you would take away or add in as we to frame our conversation?
Those definitions both sound perfectly fine to me. OPIC actually doesn't have any official definition, but you know, I think anything where people are adjusting what would be a typical role, like a typical debt role or a typical equity role, with someone else taking some of their risk, which I think is pretty much the GIN definition. That's how I see it.
Yeah, and IDB and the IDB Invest, it's sort of a range, really, and it can be a mix of instruments. For us, we don't really use the term, but we provide free grant technical assistance and investments also on blended terms, if you will, and then the combination of both in some cases, or initially one and then you know, staged, as one of the prior panelists mentioned, and sometimes both at the same time through two separate contracts, and sometimes in which are tied together, and sometimes in one contract.
Yeah, I would just say for USAID, we are not a development bank. And so we look at blended capital, and it's a term that's been thrown around really just fairly recently, as how can we use our authorities and our assets to leverage capital, and obviously towards development goals. So yeah, those definitions certainly sounded in line with our thinking on that now.
Christopher, anything that you would add to this? So you may have your mute on. I just unmuted. Okay. Okay, I'm going to keep moving, and he can jump in at another point. One thing I think to maybe separate or just make a little more distinctive this conversation from the conversation that took place before. So that was talking about capital stacks, and I thought it was really useful that they were making the point that that they could be talking about the overall capital behind an enterprise. I think when we are talking about blended finance for this panel, we're actually not talking about sequential blending, as Lori talked about it, in the sense of how do you know, this is the investment you have today, and then another investment, and then another investment. I think what we're really wanting to talk about today is when there is one transaction into which lots of different types of capital are coming. So I might put that around for our boundary for today's conversation, although certainly you can think about blended finance with respect to a broader capital stack. So let's talk about transactional blending in our conversation. So why don't we do a quick sort of round the table conversation about how each of the organizations that you are affiliated with, or in Chris's role has been recently affiliated with, where the mandates that you have either constrain or motivate the role you play in impact investing. And why don't I start with you first, George, and then I'll go to Gail, and then Amy, and then I'll pick Christopher up at the end. So we'll just go right across. So George, take it away.
Well, just quickly, and of course, our institution doesn't work in Africa, so it may be less relevant, but maybe similar to the African Development Bank, which is our main focus is poverty and economic development. So that puts us squarely in this space. And then within that mandate, the projects themselves must comply with various policy requirements, which I think many of our institutions have. And those are regarding environmental and social impact, which maybe is a little bit less in impact investing projects compared to big infrastructure, roads, that sort of thing. We also have prohibited practices definitions that are shared with the various multilateral and DFI institutions, which is, no corruption and anti-money laundering standards. And finally, we have pretty strict and heavy informational requirements. And while we manage the confidentiality of information appropriately, and I think all of our institutions do, we still want and need to receive as much information as possible. I'll stop there.
Yeah, so as I mentioned, USAID is not a development bank. We are a U.S. government agency. And one of the things that I think was sort of a shift for me coming from the private sector is when you're in the private sector, you're going to look to, you can basically do anything unless it's prohibited. Whereas what we have to do within the U.S. government is we have to look to whether we have specific authority to do something. So it's not just is it prohibited, do we have specific authority? We have to act within the authorities that Congress has given us. And so what that means is we have to get creative of how we can participate in a blended finance transaction to use our authorities. And we use that in different ways. We provide potentially grants to a partner who's going to provide technical assistance. We can leverage our relationship with a host government in order to deal with some of these, like in the prior panel, they talked about a registration requirement that was overly burdensome. Well, is that something that aid can help with? And that's, a way that we could potentially then get in and unlock a lot of capital because we've kind of reduced a hurdle that's there. We do have very broad authorities besides just contracts and grants, and we've used those. We've done a couple of development impact bonds and first loss, again, capacity building. So those guarantees, loan guarantees. So those are the ways that we use our affirmative authorities in order to participate in blended finance transactions.
And so obviously OPIC, also a U.S. government agency, soon to become the U.S. Development Finance Corporation. But the same sort of constraints will exist. We also have a statute. It will be a new statute when that takes effect. So we will have to have constraints, but we, are an executive branch agency. So, need to respond to the priorities of the White House, but also we get our funding from Congress. So there are things that we can't do because they're not allowed by our statute. And then there are things that we won't do because we know that our various constituencies would not approve of us doing those kinds of things. And so that varies over time. And that does make it somewhat challenging for outsiders to understand sort of what is in and what is out. But those shifts tend to be relatively slow. So for the most part, we're able to keep our pipeline and keep doing our deals. But over time, our priorities change and our subtle constraints sometimes change too.
Chris, are you able to join us in this conversation and say a word about the FMO? I think we still may be having trouble with Chris's ability to join us. So I'll let you keep working on that, Caroline. There you are, Chris. We're not, your audio's not working.
There we go. Now it is, I think.
Yeah, I think we'll try to sort that out.
Okay, I'll keep going. Chris, I'm going to leave you time and you can come in on all of these points. That's terrific. You know, it's interesting. I'd like to sort of dive down for a second on that because we were talking about your mandates, right? But I think what Amy was also opening up is an interesting maybe moment for us to explore a little bit more, which is you are funded no matter whether you are a multilateral development bank or a government agency. Eventually, that's taxpayer money that has gone into these institutions. And there is a level of transparency that comes with that source of funding. Do you want to say anything about how the transparency or the accountability functions or oversight functions, be it through maybe your board, George, be it through the board of OPIC, be it through congressional oversight, how that also can shape the way an agency operates?
Sure. I mean, that is definitely an issue for us. You know, we will not sign confidentiality agreements. We're not able to because of the FOIA. But in addition, we would not be willing to limit ourselves strictly to FOIA because we get inquiries from members of Congress and we need to be able to respond to them. So we are not willing to limit ourselves to the strictest confines because we do need to serve that other function. But obviously we're not willy-nilly handing out confidential information either because we know it's important. But yeah, I mean, also I think, you know, people need to understand that sometimes during the process, additional questions that seem to be coming out of left field are coming from other constituencies, like a board, for example, or you know, the people that are you know, the State Department, for example, may have a question, and the project team doesn't realize that the question is coming to them from the State Department. But that's just something that goes with the territory.
The Inter-American Development Bank and the Multilateral Investment Fund, which I work for, their board is made up of the member countries that constitute really the founders and the capital of these institutions. And so they are the ones who need the information and require, since they're governments, require that, you know, the basic information about what we are doing in all of our projects be made public. That said, we aren't subject directly to the Freedom of Information Act in the U.S., though the U.S. is one of our member countries. And we only provide the sort of need to know for the approval information to our boards. There may be, you know, very detailed elements of what these projects are investing in. If it's an investment fund, the investees of that fund, you know, how much does the board member need to know all the details about those investees? So, or the borrowers directly. And so there are limits there that are some level of protection, I think.
Can I add something on that for USAID? Because I don't want folks on the phone to think that working with USAID means that information will, you know, is going to be provided to the public. U.S. government employees have an obligation under a criminal statute to not disclose non-public information. And when we're working with other parties, they can absolutely mark information as non-public. And under FOIA, there's exceptions for non-public information. And we've also learned, as we've worked with the private sector a lot more, ways to protect that, meaning even if we get the information, we may not actually take it in our possession. And so there's a lot of ways to still work with USAID and keep your information confidential. So I didn't want to leave the impression that anything, you know, you work with us and they're opening the kimono. That's not the case.
Thank you. I think that's a good thing for people to be aware of. I appreciate that. But it does suggest, these are very different types of organizations. And when they come into a transaction, they bring with them a lot of different constituencies, shall we say, that are observing what they're doing and watching what they're doing. And that people have to be mindful of that and understand, as Amy was saying, that some of the things that are being asked for may be coming from those constituencies. And they do have changing points of view from time to time. So let's go in now to talk a little bit about some examples of actual blended finance transactions that your organization has supported, where you've successfully crowded in other types of capital. I thought it was very interesting from our last panel to hear, I think they were generally happy to have you in their deals. They talked about the credibility that you bring, the way you signal to the market and to other investors that this is an investable project. But they also did talk about the complexity and sometimes the challenging of harmonizing documentation when there's multiple diffies or iffies in a transaction. So if you each could come up with an example of where you felt that your organization was really pivotal in catalyzing and unlocking other types of capital into a transaction, I think that'd be terrific. And any lessons that you learned from those transactions. Do we have Chris able to talk to us yet?
Hopefully we do.
I'll have the picture now too.
Yeah. We're waiting for him to call it.
Okay, terrific. I'll go ahead then, and George, I'll put you first again. We'll go right down the line again while we're waiting for Chris. Thank you.
Thank you very much. Well, the first panel did describe, I think, one of the examples I was thinking of, which is of an investment fund. We have been investing in various accelerator funds, and in these cases, we have taken an initial lead in helping the fund manager design the documentation. And some of these fund managers, I should say, in environmental funds, for instance, we've had some repeat funds with these fund managers. And so the documentation is such that it's more open to the market to come in. So we may have initial, not a closing, but initial agreement on the documentation, and then 4 to 5 months later, that fund manager is taking that documentation out and selling it and bringing the market of private sector investors in. We've seen that, and then we've seen initial funds with the fund manager that are small with us and maybe other development finance institutions. And then a follow-on one with that same fund manager, now that they have experience in the market, which are much larger, 4 to 10 times as large as that initial fund. So that's how I see some of the crowding in. And then the other, I wanted to mention, just squeeze in here one other element that IDB can do to bring funding, which is we are allowed, and the African Development Bank probably also, we are allowed to have internal trust funds. So we bring in money from private sector as well as public sector institutions. We have NOR Fund, we have the Swiss government, we have the Gates Foundation to bring money into the IDB as a trust fund approved by our board, and then that can be combined with our own capital or even substitute our own capital because we're treating it as our own, and then that money benefits from the fact that the IDB receives certain preferential treatment by its member government. And so it opens the door to bringing in some of this additional capital. In the traditional private sector lending, it's called A loan and B loan, and that doesn't even require a trust fund. The B loan would be our outside banks, but they're still under the general cover, that political cover, if you will, that we provide by doing these transactions with our member countries. Thank you.
So for USAID, one of the things that we cannot do, we do not have authority to hold equity. So USAID cannot directly invest in a fund. But we have found many, many creative ways to still participate in a fund, to provide our blended capital. And some of you may be familiar with cross-boundary energy. And that was a situation where, and we haven't done this a lot, where we provided some first loss capital to cross-boundary, as well as covered some of the management fees for the fund. Those are things that we can do, even though we can't hold equity. And that was a way that we could make the cross-boundary fund very appealing to other investors. You know, again, because we can't hold equity, we do things like we have worked with the Department of Commerce and provided our money to Department of Commerce, who then has a really cool program where they are training lawyers overseas, so that there are more lawyers who are trained in private capital markets and investments and transactions, as well as working with host governments on how they can set up sort of the framework that's needed within the country to support these. So it's not a direct investment, but it's ways that we can use our money to support the transactions ultimately.
So I have two. I have a real deal and then one that's theoretical. So the real deal is one of my favorite deals in the history of OPIC that I worked on. Back when Ellen Johnson Sirleaf was elected president of Liberia, the U.S. government under George Bush was very, very interested in supporting Liberia as a country. So it became a priority within OPIC to find a deal, to find a way to do the first deal in Liberia since the Civil War. So lots of studies, lots of conversations. Eventually, what we were able to do is find a donor that was willing to make a donation to a nonprofit that was then able to capitalize a non-bank financial institution that OPIC made a loan to. So that non-bank financial institution could on-lend to SMEs in Liberia. So that was, on the OPIC side of it, an extremely high credit risk as well. So we were kind of blending ourselves a little bit in that. But the interesting thing is, so the equity was basically a donation, but the nonprofit, you know, it was only able to do the deal because it got the donation from the donor. So ultimately that all turned out and the company was sold and recapitalized, and we continued lending. It was extremely challenging, and it definitely would have happened, but for us working really hard to make that all come together. The theoretical one is interesting, as you're talking about that you guys can't make equity investments, because obviously OPIC can't either, but the new DFC will be able to do so. I guess in some ways our, what we call the unlevered facility, OPIC created private equity terms that were more equity-like to try to work better with the other DFIs. And so basically sort of shifted our risk. Instead of being a normal senior lender to a private equity fund, we were much more pari passu with the LPs, and then shifted our risk, our seniority to the very end. So we have a very small piece of seniority in that product. So something that's going on in the market right now is trying to deal with that bit of seniority, because people still don't like that. It's just because we're a little bit different than the other LPs. So what people are pursuing is actually obtaining commercial insurance to insure against the risk of OPIC seniority at that last piece. And there is a nonprofit that is willing to pay the insurance premiums to cover that risk, which would be great, because then the LPs don't have the risk, we have our seniority, and it actually perfectly shifts that risk around, because then the LPs are no longer taking it and it's insured.
Well, that's fascinating. So you're actually blending in yet another kind of capital, which is insurance.
Yeah, exactly.
Because you're there. That's interesting. They're taking out a little bit of the risk you present to the transaction. Is that what
exactly.
Fascinating, fascinating. You know, I think it is worth maybe pausing for a second to just, you know, what we're hearing about is we're hearing about all these financial instruments that are being used to transfer or mitigate risk and a variety of risk. And so we're hearing about equity, we're hearing about debt, we're hearing about mezzanine finance, we're hearing about guarantees or first loss capital, we're hearing about insurance, we're hearing about grants, and yet they're also non-financial instruments or non-financial aspects of what a DIFI or an IFI can bring to the table that is quite useful in a transaction. One that I'm thinking of, but I'd love to open it up to the panel to reflect on as well, is where you see, and again, this could be philanthropic capital or capital that comes from you, but where people put together, for example, a technical assistance sidecar. Right? So the technical assistance is there to help de-risk the investment because you're providing additional support for whatever it is that the project is trying to achieve. That's an example I've seen where I wouldn't necessarily say that's a financial instrument, but it's a very, very important aspect of having some of these aggregated capital structures work. Have you all seen other types or versions of maybe a non-financial instrument or just your relationships that can really be brought to bear to help a transaction really achieve its goals and succeed?
Well, I'll start because honestly, the Liberian transaction that I was just talking about, because that was the first non-bank financial institution in the country, we spent significant time dealing with the central bank in order to create a regulatory framework for that borrower to even exist. So that, you know, the fact that the government was willing to have those conversations, I don't think they would have been willing to have those conversations had we not been the U.S. government. So there was that one, and I've had other experiences where OPIC, the U.S. government, having conversations with regulators, central banks, have resolved issues for commercial parties that they would not have been able to resolve for themselves. And both at the structuring side of things, and sometimes when things go south and you know, problems need to be solved. So I think that's a big part of our role.
Actually, we've seen similar roles here at the American Development Bank. Since the bank itself does public sector lending to the governments and provides grants for technical assistance to our member governments in Latin America, and maybe the African Development does similar. We've used that as well as grants from the window that I work with, the Multilateral Investment Fund, to help build the local ecosystem for different types of investment. And we've particularly targeted sort of investment fund structures in the region, and that's really allowed these to blossom in various countries in our region. Yeah.
And I would say for USAID, I mean, I've said it a few times already, but that absolutely that it's since we can't take equity, right? It is those kind of sidecar TA things that we are mainly doing. And in Africa, I know a lot of it is to build legal capacity. And then I would say too, it wasn't, the other thing we do, you know, as far as kind of outside the fund world, is, you know, we were working with Google in Liberia and helping them get their licensing in country so that they could then move forward with internet connection in Monrovia. And without USAID, you know, it would have taken, you know, who knows, right, years for them to get that licensing. But we were able to actually have the government of Liberia partner in the project. And because of that, they had a vested interest in it going forward. And so it moved pretty smoothly.
I just wanted to jump in with one more example. Sorry to take the floor again, but and I know when I mentioned sequential financing, I'm really thinking also about one transaction, because oftentimes we'll start with a grant either to that entity or to someone who's active in the area. We provided a grant, and this is something that some of your clients in the region might be looking for. where the grant assisted in understanding in a part of Chiapas, Mexico, as to forest conservation and how to manage that with local coffee growing. And then the loan went to a coffee cooperative that would then use that money. And that loan didn't go right away. It came after the grant was really well underway and the sufficient learning had taken place. So there may be some cases where you see instruments that can combine in that way.
Yeah, I'm going to give yet another example, and this comes out of not when I was sitting in at OPIC or at the European Bank for Reconstruction and Development, but when I was negotiating a deal with the IFC, and the group I was representing really wanted the IFC in the transaction, not only for their money, but actually also for the how can I say this, the ability to be able to say to the government where we were happening to have this project, that we had a zero tolerance for any type of corruption, any type of bribes. We had that anyhow because we were a US-based organization, but it really strengthened, we felt, our hand if a government official came into our enterprise to be able to say, not only would we not want to do this, but we have investors that are going to hear about this request that you're making. And these are investors who you probably would be uncomfortable having us go to the IFC and say, look, this is what they're asking us to do. So it was an interesting, in a way, almost a form of political risk insurance by having someone in the table without actually buying the insurance to just say, look, you do realize who else is in this investment and who is watching what's happening. I don't know if you all have any observations about that or not, but I know it was very important to my client to have that voice at the table that we could go to if we needed to.
I've been told that by borrowers, that they have used that as a shield when asked for bribes, so it's nice.
Mm-hmm. I may have just heard Chris. Is that you, Chris?
Yeah, I think I finally cracked it, and after
I'll give you a couple of minutes to reflect on everything you heard.
Oh my goodness! Well, I'm afraid I may have missed about 15 minutes of it while trying to relay fiber optic cables between London and Washington, D.C. and New York. I think I just caught the end of what you were saying there, Deborah. I think the DFIs generally, from my experience, certainly working with them both as external lawyers and in-house at FMO, is that the DFIs do help leverage private investment and interest into the projects from foundations right the way through to commercial investors, just by being there, because it is sort of a seal of approval. If you've got your DFIs in, you've got the right policies, the right implementation of the ENS protection, the anti-corruption, bribery, and it's being monitored, and it really is a seal of approval and comfort to other sources of finance, and just helps to crowd in that finance right across the board.
No, thank you. And I think that sort of leads to my next question. So we have a bunch of lawyers listening into this conversation, and hopefully at some day, probably not you, George, because I don't think the Inter-American Investment Corporation is going to start working in Africa, but all the rest of you probably will continue to. What do you wish the lawyers sitting around and listening to us right now knew about how to work well with your organization? We heard a little bit of the criticism about the complexity and the reporting that is required. If you were to sit someone down and say, hey, this is what a lawyer on the other side of the table from me, when they're effective, this is what they know and this is what they do. What is the advice you would give folks?
Well, I'll start. I guess I would say that to understand that, to kind of think about USAID as a potential partner in a transaction, again, not from an equity standpoint, but well, what are the hurdles in that particular transaction? And those are the things that USAID can come in to help with, you know, as we've already talked about, the first loss, the sidecar, TA, helping with any regulatory hurdles, helping to work with the host government to actually put in place a host government policy on something that would help, some kind of public-private partnership type policy that we've done, or you know, something else that kind of eases the regulatory burden on transactions. So that really is the way that USAID can get involved, but also to know that USAID, that because of the way our appropriations come, that our money can be spoken for very early on. So we really are hopefully a long-term partner. It's going to be harder to come in and say, hey, we've got this deal on the table, we need X, and for us to pivot quickly. But it's the type of thing that right now the agency is really looking at supporting transactions, being part of the supporting the private sector. And this is an absolutely vital way for us to be a part of it. And so we have investment officers in many of our missions, especially in Africa, and other individuals who are looking ahead in the you know, 1, 2, 3, 4, even 5-year cycle of how we can spend our money to help catalyze private capital. So, you know, we can't necessarily give, now I would say the exception to that is we do have a way that we can provide money into kind of a lump sum into a PIO. And so if there's a PIO involved, we potentially have even more flexibility. Public international.
I'm going to have you stop for a second and spell out the acronym that you just used in case others don't know what you mean by a PIO.
Yeah, a public international organization is an organization that really is made up of sovereign states. So you've got, you know, the UN entities, the World Bank, but there's also a lot of smaller ones. One that I actually wasn't familiar with until someone provided me some information is the African Legal Support Fund. And that's an entity, a PIO that we have supported and can support with a little more ease than other entities.
So I'd like to go up to the 10,000 foot level. I think for lawyers and business people and anyone who is engaging in the process with OPIC, I think also the other DFIs probably, and thinking about how you're approaching diligence and how you're approaching marking up the contracts and engaging in negotiations, remember who you're dealing with. And by that I mean, we're not a vulture fund, we're not a commercial bank, we're not trying to steal your assets, right? So there may be onerous looking terms in the loan agreement, but the point is that we're trying to achieve development and we're long-term partners and don't have a hair trigger to default. We're not trying to default your company and take your shares. We really don't want to do that. So when there's an issue in the documents that startles the other side, the best reaction to that isn't to just delete it in your markup. It is to highlight it and start asking questions. What does this mean? We're worried that this will cause you to do this thing, for example. And then it's a conversation. And further to that point, I think more disclosure is always better, right? So the DFIs, OPIC, you know, we are accepting a certain amount of risk in emerging markets. What we don't want to accept is something that our borrowers aren't telling us about. So we want to analyze the risk and mitigate it to the best of our ability. So that requires sort of the building of trust and just as much disclosure as possible. And I think borrowers have better relationships with us when they report early and often. Something has happened, the local government is trying to do something, or there's laws are changing and we're worried and we need waivers or amendments or whatever. The best way to deal with all of that is to tell us as soon as possible. And, you know, constantly reporting, constantly having conversations, and not waiting until the last minute when things become really desperate. And then also, I think someone had said in the last panel about not having the perfect be the enemy of the good. I think that's incredibly true, because people look at these finance agreements and there's a lot of constraints in them, and people start thinking, well, 10 years from now, we might want to do X, Y, and Z. That's fine, but if you start building in your potential future plans on day one, it's going to add complexity to the agreement, and every sort of lever that you pull that creates a risk is going to cause sort of a, you know, another lever pull on the other side. So you may be better off just really asking for what you need right now and coming back in 5 years if the situation has changed, and you would be in a better position then, presumably, because your project will be in better economic shape, and so you're in a better position to ask for changes at that point.
No, that's a wonderful point, Amy. Chris, I'm going to say something, then I'll open it back to you, which is something I don't think we've said, which is the long-term horizon of some of the investments that you all make. You're not in for the short term as a general rule. These are very long investment periods. So Chris, go ahead.
Yeah, I think just building on what Amy said, I think it is about sort of understanding who the players are. So understanding as an external lawyer, understanding the role that your client wants to play, and understanding the role that the DFIs or IFIs can play in that, and really getting to know what their risk tolerances, what their policies are up front, having those open conversations, understanding the interests so that you can align them. And to that end, I think one of the problems I often come across, and this was true when I was in-house, and it's still true now, is there's sort of a failure to right-size your legal contribution, because you're not looking at what the ultimate interests of the client are. Now, I understand as external counsel, you always have to sort of work in the best interest of your clients and you know, advise them on all the risks and so forth. But you need to have that conversation up front and really make sure that you understand what the risk tolerance is, what the interests really are, and try and align that. And you know, moving to sort of the longer term goals, I think the fact that the DFIs and the IFIs are in this for the long term, as Amy said, it's about solving those problems together. It's about working and cooperating together. It's not about trying to get one up on each other. I certainly come across a lot of people who start throwing around the phrase, "It's not market." It's really about understanding what is market in these sorts of transactions with these sorts of players in these sorts of regions and countries. Because what's market in U.S. M&A or U.S. fund formation is probably way off market for what we're actually trying to do here and what is actually needed. So it's about understanding at the end of the day. And just one more sort of comment, and this picks up on something that was on the previous panel. If you're advising a client that's looking for DFI or IFI funding, try and steer them away from throwing all the bells and whistles onto what it is that they're trying to do immediately. You know, using the same sort of analogy as right-sizing your legal contribution, encourage your client to right-size their project. If it's the first time that they've done this, make sure that you're getting something on the ground or in front of the IFIs and DFIs that is really a proof of concept and something that can get off the ground. Because the more complex and the more bells and whistles you throw on these things, the less likely it is that you're going to get funding and you're going to end up with a deal at least in the short term, if not in the longer term as well.
Thank you for that, Chris. So I want to, we're moving to our Q&A section of this conversation. So if anyone who's listening does have a question that they'd like, please do send that in to Carolina. She's keeping an eye out for you.
We have one question.
Okay, please.
So this question is directed at Amy. It says, Amy, you've mentioned how government agencies need to be cognizant of their mandate limitations when participating in blended finance transactions. Are there specific regulatory/policy enablements, active or expected, that have been conceptualized to make it easier for agencies to participate in the market?
So that's interesting. So there's no regulations for us in the standard regulatory sense, right? So we have a statute and we have internal policies. So I think that the challenge is, I'm in this strange place because my agency is going to be dissolved and be a new agency in about a year. So a lot of the constraints actually that are on OPIC will not be on the new DFC, which is great. You know, but one of them, and I think you talked about it with KYC and you know, transparency. You know, one thing is, some investors are looking for liquidity, right? So you might have a piece of a capital structure that people want to have highly liquid. That's challenging for us because we need to know who we're doing business with. And so having something, if it's something that's publicly traded, for example, on the New York Stock Exchange, we can take some comfort in that regulation as a protection for us. But if someone is trying to have, for example, a large number of very small investors that are constantly moving in and out, that is hard for us to get comfortable with unless we can get assurance that there's a KYC overlay that's sufficiently strong for us to get comfortable.
So I'm going to allow, we've got just a few minutes left. I'm going to allow everyone to say a few last words. And you know, one possible way of framing your last words is to talk a little bit about just the general skills you think this legal community of practice, what we should be trying to achieve in order to facilitate more blended financing in the world. But I don't want to limit you to that. If this whole conversation has led you to feel that there's another point you'd like to make, please do. So I'm going to go, I'll go my regular order, George, Gail, Amy, and Chris, then you can be our cleanup batter. So go ahead, George.
Thanks very much. And I think so much has been said in both panels already on this, but I like to throw in the word patience and look at the big picture. And I always ask my teams, okay, when you look at the documentation, what would the judge say if you had to bring this before a court? Is it sufficient that a court would, in theory, understand what we meant here? And if so, we'll probably be able to work out any issue in the documentation with our counterparty. So it's just what Chris and all of you and even the other panel said, you know, right size, the work and your focus. And the one other thing that I will attribute to Mary Rose Bushewitz, one of our colleagues in this field, is our institutions are really loyal investors. And once we go down the road to contribute to you know, your project or your company, your client's company, we don't want to throw in the towel unless it's really an extreme case. We want to see the project be successful.
Yeah, I guess I would just, I mean, really just reiterate what I was saying before, is that, you know, USAID wants to help with any hurdles or any, you know, issues that are stopping on the ground transactions. That if you see something that is a problem, you know, reach out to the USAID mission in your country. There are investment officers, there's economic growth officers, and they would be happy to talk to people about what ways USAID can help, you know, smooth the road.
Yeah, and I think this has been said, but I think the proper skills for a lawyer representing a borrower investor in the blended finance space is patience, but also someone who is looking to solve problems and achieve goals as opposed to winning points, right? So it's important that your clients understand what they're agreeing to and what the expectations are, right? So that everyone understands why everyone's in the transaction and what everyone is really expecting to happen. And again, there's some trust and some faith involved in that, but that everyone's really on the same page. And if that happens, as George said, if there's problems down the road in the documents, that they'll be resolved.
Chris.
Yeah, I think for any lawyer that's sort of looking at this area, I think it's the skills that are required are pretty broad. And I'd second what the panelists said in terms of pragmatic problem solving, understanding that the DFIs and IFIs are loyal, but I'd also add that they're not blindly so, because at the end of the day, no one wants to be taken for a ride, and many of the DFIs do have very strict commercial requirements and objectives. But the great thing about working in the space is it's extremely varied, and you get to bring in lots of different product types. And in terms of blended finance, you could be doing anything from day to day. Whether it's looking at grant funding or concessional financing, through to private equity funds and straight equity investing or VC style investing. It's all on the table, and sort of mixing it all together is probably one of the most dynamic and exciting areas out there today.
Oh, that's a wonderful comment to end on, and I'll add my last words and then hand it back to Carolina. So we talked a little bit earlier today about why the Grunin Center came about and what we're trying to achieve, and I want to give a shout out to our partner in these activities, which is the Impact Investing Legal Working Group. And that really came about because we realized that the lawyers working in this space didn't have a natural place to go to do a sharing of experiences and learnings. And as a result, we were not always as effectively or efficiently representing our clients, no matter where we sat at the table. And so I think what you all have had an opportunity to see in operation today, both with the first panel and this panel, is a real generosity among the lawyers working in this field to say, we're going to take time to share what we've learned and continue to grow and learn from each other. And that's just really an extraordinary aspect of this community as well. And I'd like to welcome all of you who've been participating in either speaking on the panel, but also those who have been sitting and listening to just continue to contribute to this community. We need your voices. We're learning from each other. And as a result, we really will have even increased impact in this world.